So far in the program, we've heard about a lot of the issues as well, some of the challenges, and we have a sense for the macroeconomic backdrop. And our panel here today will actually help us unpack some of the investment opportunities and talk about it in the context of how investors are viewing this, as well as some sense for returns and future debt and financing models. I'm going to, so we have Martina Garcia from the London Stock Exchange. We have Peter Budd at Ove Arup and Partners, and we have David Sayre at KPMG. So we'll get a wide representation of views here on some aspects of the financing. So I'm just going to kick things off with a question on what the financing and the participation has looked like from international banks and fund investors, and what can be done to improve that. So that's a two-part question. So I'm going to kick it off to whoever wants to start with that one.
Well, I think a great proportion of the financing of Belt and Road infrastructure thus far has come from international development banks, including AIIB, Chinese development banks, and Chinese banks. But you're seeing increasing participation from the banks which have always been focused on China and ASEAN. So HSBC, Standard Chartered put a huge focus on that. And I went to Beijing with Lord Sassoon, with the Chancellor and the Chairman of Standard Chartered, HSBC, Barclays. There's a huge interest in what Britain can do to increase the funding capacity of Belt and Road, because that is a constraint. And Lord Sassoon was kind enough to mention the paper that we drafted with China Britain Business Council and Citi UK. And we see there is a very real opportunity for UK financial services to increase the capacity and accelerate the development of Belt and Road on commercially viable projects. And that's the key thing. You can talk about new financing models as much as you like, but the fundamental essence is that a project needs to be financially viable. It needs to be commercially viable. It needs to capture the externalities. Infrastructure does work. I mean, it has worked for China. China has lifted itself and 1 billion people out of poverty, one of the greatest economic miracles. And one of the greatest drivers of that has been infrastructure-led growth. But China, because it's one country, has automatically captured the externalities. In terms of designing infrastructure for Eurasia and taking the vast expertise and capacity and cost effectiveness of Chinese contractors, you've got to devise projects which capture the externalities. And very often, the infrastructure alone doesn't produce a sufficient return. You've got to capture the development value in the land and the value of the trade. And if you can do that, you can build a truly viable project which has had a proper feasibility study, where in a third country, the engineering design and project design is probably done by an Arab or another company that is really used to designing infrastructure in those countries for those populations, and has a legal structure which is well understood by financial providers and by investors, and a dispute resolution which is also understood. If you do all that, then you can do what the city has done through generations and articulate to global investors, here is a commercial opportunity, here are the risks, and actually there is a huge amount of money post-QE which is seeking a 25-year plus return, which is inflation-proofed. If we get this right, it can offer it. And in terms of new financing models, the only one I would say is truly new is the real focus on green, which is why We've all put so much effort into the City of London Green Finance Initiative. And if you're trying to build an infrastructure project that's going to last 25 years, you're going to want millennials to be buying the stock in that and buying the bonds. And greenwash doesn't work. It's got to be truly green. It's got to be environmentally sustainable. Otherwise, you're going to build something that nobody's going to want to buy in 10 years, in 20 years. You know, my kids, green is one of the first things they think about. You know, as they start investing in small amounts in ISAs, you know, they're constantly looking for the greenest fund. And I think that's what firms like Standard Aberdeen are seeing, that really you've got to have an increased focus on green, and I think that is absolutely vital.
Sorry, go ahead.
Well, it's always a challenge following David when we get onto Belt and Road and strategy. But I'd like to ground things a little bit. Greenfield infrastructure anywhere in the world is a huge challenge in terms of getting a commercial viable return on investment in a reasonable period of time. So when you start looking at some of the geographies that Belt and Road is touching, they are all extremely, or the majority of them are extremely challenging. So why are we surprised that Western institutions are not prepared to actually support the funding? I think the major opportunities for us are going to be around the additionality of developments around the primary infrastructure. And in fact, I think the only major infrastructure project that was almost greenfield, which turned a profit almost on day one, was the Hong Kong MTR. And if you think about it, that wasn't about transporting millions of people every day, which it does extremely efficiently. It was about generating air rights over extremely lucrative development in development locations. And I can see the opportunities starting to develop around Belt and Road, around urbanisation, industrialisation, all hopefully, well, I think it's an imperative that that's developed with a greenfield, a green agenda, a sustainable agenda. Because if you consider that Belt and Road is touching 60% of the world's population who are now consuming some 30% of the world's GDP, if we don't get the sustainability agenda right, then we are storing up an absolutely huge problem for ourselves. And I think that, as David mentioned, will figure into the return on investment and the viability of assets. That's not to say that the infrastructure assets will not, at some point in the future, be a very attractive investment propositions. I've spent most of my career looking at airport development, and I can tell you that pension funds, as you probably know, are all gagging for capital city airports, or the expansion of those airports, because they are seen as extremely good, secure investments over the longer term. And I'm absolutely sure that some of the investments that China has been stimulating are going to reach into that asset class in the near future. So I think there is a rosy future. I think China has actually slowed its Belt and Road investment for the reasons that previous panels have discussed. And I think there have been a number of unintended consequences around owning infrastructure assets almost by default. And I think what we're going to see coming out of the Belt and Road Conference at the end of this month is a refocusing of that strategy. My experience working with China over the last 40 years is that there is a plan which may be slowed or accelerated, but the plan is there. And I think some pages of that plan will be revealed over the coming months.
Martina, did you want to kind of talk a bit more about the commercial viability and what your observation has been around that?
Yeah, let me go back a bit to the financing, yes? Because, I mean, obviously we are going to see things slightly differently, I suppose, as an exchange. We also give we have three ways of, I see three challenges, yes? One is to reduce the debt, if you want, yes? I mean, and some of these points might look a bit marginal, yeah? But what we are seeing is a quite significant amount of innovation in some of the classical infrastructure products, yes, which will be very good to support. And here, for example, I'm going to mention, I was in the last week, the ministerial of the Economic Commission for Africa for the UN. And there was a session on railways and on financing rolling stock and of using leasing to finance rolling stock. And the need for having an international protocol in order to be able to do it cross-border. The officials from the Ethiopian railway ministers were assessing 30% reduction in the cost of the Addis Ababa, Djibouti, and Addis Ababa future towards Kenya railway line. This is enormous, yes? Lord Sassoon mentioned Komodo bonds. Komodo, and we had very recently an Uzbekistan bond in local currency. Very important for governments to be able to issue in offshore local currency because it really enables them to manage risks much better, and there is a reduction. So this, you take here, you take there, you reduce, huge impact on that sustainability, and something that we are very keen to work with people. Second point I will say is working with China. And again, Lord Sassoon mentioned the Shanghai-London Stock Connect. I see that as very important, obviously. This is my main job in life. It's an equity product. It's a single stock connection at the moment. So in terms of Belt and Road, yes. But what's really important and is going to create is an ability, is developing an ecosystem in the City of London that knows how to cooperate and work with China. And when we are looking at the Belt and Road financing, what we are seeing is then, as David was mentioning, a bulk of the initial, of the most difficult investment in the infrastructure, in the riskier investment, has been done by China and by the Chinese institutions, the development banks, the funds they have, and also obviously by the multilaterals. And the challenge here is how to pass the baton for the international finance in projects that might be less risky, either because they are closer to completion or because they are more towards the ancillary kind of business, I will mention, in terms of the hubs, the monetization of the initial infrastructure. And the third thing that I think we need to discuss is how to bring institutional investments to the table.
Right.
Because the banks are there, and the global banks are, well, some global banks are there. What the key challenge right now is the asset owners, yes? And this is something that where the bulk of the innovation needs to happen in terms of the structuring of financing instruments.
So have we seen sort of fund managers, the buy side, are they kind of, are we seeing a lot of participation? And what are the types of projects, whether, and what stage are we seeing a lot of the buy side money managers coming in to supply some of the funding or investment?
Well, I think it is getting off the ground. It is early stage, but as Peter and Martina has said, the real opportunities in the short term are likely to be more like investing in Chicago or Swindon than investing in the Great Western Railway or Amtrak. As infrastructure is built, you get real commercial opportunities, and I think that's where fund managers, you're seeing Green Investment Fund, you're seeing Standard Aberdeen, you're seeing a number of others looking at the very real opportunities to invest in the consequences of built infrastructure and capture the externalities that are not actually captured within the original project. So looking for smart cities developing, looking for railway hubs, looking for marshalling yards, looking for distribution centres, for the Alibabas and the others, looking at ways to exploit the infrastructure for trade. I think that's where, looking at it through an entirely commercial lens. You talked about strategy. I had the rather challenging privilege of being a strategy manager for Sir Brian Pitman when he was chief executive of Lloyd's. And he said to me once, given that strategy was in my title, he said, when everybody mentions strategy, I just reach for my gun. we should never do anything for strategic reasons. We should do it entirely for commercial reasons. And there truly are commercial opportunities here. Yeah. And I think that, you know, London is, and UK financial services can make a huge contribution to realising the opportunities coming out of the infrastructure that is being built.
Yeah, I just support David's view. I mean, I think there are 3 stages effectively in the Belt and Road development. The first is the basic infrastructure. The second is urbanisation and industrialisation. And the third is the social impacts of the previous 2. So you then start to see tourism, healthcare, social services, which are much more much easier to quantify and deliver in the context of Western financing models than the original infrastructure work, which I don't think was ever really going to work in using a Western model.
One of the things that we had talked about earlier is the return streams and the returns expectations. We're in a world where returns for most large institutional investors it's been challenging given the rate environment, and infrastructure is one of those. It's one of those. I mean, I'm not going to call it an it's an asset class, but how do you turn the Belt and Road into an asset class for investors? I think is sort of a relevant question for the institutional investors, and I was curious to kind of hear your views on that.
I mean, we are doing quite a bit of work in the City of London, not just us, and looking at the different options. It's challenging because you have the longevity of the infrastructure and the geographical type risks. So various ideas. I think we have to recognize the role of the potential of blended finance and the role of more institutional public money, whether from multilaterals, from governments, from some of the sovereign funds, yes, and we have seen very interesting examples coming out of Singapore at that level, that then can play in reducing risk. The role of potential role of structuring the funds a bit better. And here, obviously, the classical structure diversification, but very difficult with infrastructure projects because they are so different, and the revenue streams are so different. But we can do that. I think as an exchange, and it's extremely important to also have an instrument then guarantees a certain level of governance. And here, the idea of listing. It's extremely important. And then to finalize, having liquidity, exit. I mean, if you want to attract institutional investors, you need something then they can exit. And again, the use of public markets, I think, will be extremely important to facilitate that instrument.
David, you were going to...
Yeah, I think to develop Belt and Road infrastructure as an asset class, you need data. And I think one of the things that London has been good at is developing information. I spend a lot of time wandering around Beijing, talking to MOFCOM and others, trying to get the database of Belt and Road projects with absolutely no success whatsoever, I have to say. But firms like Refinitiv, and I see Henry Tillman over there, are producing more and more data about Belt and Road projects, and then you can monitor the performance. And frankly, to be a successful asset class, it's quite important for the first projects to generate success. If early investors achieve superior returns, then the nature of markets is that others will pile in. One of the challenges for Belt and Road right now is that some of the early projects have produced poor returns, which makes people more thoughtful about piling in. But the more we can see information about successful projects, and you know what? The criteria for successful projects are going to be similar. They really are. The more we can see successful projects and we understand where they are and what's working, the more you're going to build an asset class that people want to buy into.
And what about geographical risk and how institutional investors and financial institutions are viewing geographical risk? And is there a risk of asymmetric kind of investments, everyone going into safer regions or regions perceived as safer, and some of the most needy regions or countries being kind of cut out of the loop there?
Well, I think that's a natural behaviour, isn't it? And the fact that China has really kicked off the Belt and Road Initiative in some of the most difficult geographies, both in context of political stability and, often more importantly, the whole security issue, I think is a great credit. But I do think that the Chinese view of Belt and Road projects is maturing, in that the earlier projects were very much commissioned, developed on the basis of a political, geopolitical agenda. And what I think we're seeing now is return on investment and the Chinese financial institutions actually stepping in with a much stronger position to actually make sure the projects that are now moving into this phase of the development are really are far more commercially attractive, viable, and have the ability to deliver their financial objectives as well as their political and social ones.
And I mean, we should speak about multilateral banks, because that's the key role, and they are doing it. And what we have also seen in terms of innovation is a much greater degree of collaboration, I think, than, for example, at that level, the AIIB working with the ADB in certain jurisdictions. And also a lot of innovation in terms of the structure of some of the funds they are using, yes? And for example, the IFC with Almundi, working together to try to see how Almundi can then invest in a wider geographical range than before. So, and this is their role, is to invest in these very difficult geographies for private money.
But I think for the UK, investments around ASEAN, investments around more Anglophile countries in East Africa, in the Middle East, where we've worked successfully for decades, there are a lot of areas where we really do understand that geography, we understand the politics, and we have competitive advantage against others who really don't.
I think it's hugely important, the point that Lord Sassoon made about his forward with Chinka.
Yes.
In the document that's going to be presented at the Belt and Road Forum at the end of the month. There's a clear recognition that some of the projects, the earlier projects, have not gone the way China wanted them to. And they are certainly looking towards the UK and other developed economies to actually turn some of these Belt and Road projects into really tripartite ones, where you have the recipient country, the Chinese element, and a foreign partner who can help to shape the proposition in an appropriate way. And I think that is a huge opportunity for the UK.
It is.
Just to follow on from that point, what have been some of the lessons learned apart from having multilateral engagement? What are some of the other lessons, early lessons from the few years that we've had this the Belt and Road investments?
Well, I think one of the risks is that you get a third country government which has never had any reason to produce a sensible infrastructure plan, and you start saying, gosh, where would you like us to build this? And local political requirements get in the way of commercial viability. And I think it's really important that everything is looked at through a truly commercial lens, because that's the way you manage political risk. In democracies, if a local politician routes a road near his region because it's politically important, actually that is adding to political risk. If you do things very differently from some of the earlier Belt and Road projects, if you use local people to provide the wood for the doors, to paint the doors, to actually do a huge amount of work and create local employment, then you are truly managing political risk. If you import everybody into a local community and you build it around them, they don't feel involved, that generates political risk and resentment. And I think there's a lot of learning that has been done as a result of some of the early projects.
Yeah, you're absolutely right, Dave. And you can see the more recent projects being shaped in a very, very different way.
One question on the role of private equity and how we might be able to engage more of private capital that doesn't have the same kinds of sensitivities around stakeholders. They have that longer the longer liquidity and the time frame that seems more suited to infrastructure investing. And also a greater risk-taking ability. And so what is your perception on kind of the role thus far of private equity and other private capital and how they can be encouraged to invest more in the Belt and Road?
Well, I think a lot has been invested. Far too little has come from Europe. An awful lot has come from Korea and Japan, where they're looking at infrastructure being built and saying, actually, where are the commercial opportunities? And they've really seized them. In some places like Cambodia, Vietnam, etc. Actually, where huge infrastructure is being built, there are immense commercial opportunities, and rational private equity investors look at what is being developed and say, actually, let's just leave aside the viability of the core piece. What are the real opportunities coming out of this? And just simply looking at development land values, looking at the potential for marshalling yards, hubs, what you can do in terms of just building smarter cities for the workers around those areas.
As we were mentioning before, it's also very important to think of things that are not just infrastructure, but once you build the infrastructure, how you're going to use it, yes? And in that sense, obviously, equity and, just the ensuring that corporates have access to capital is absolutely key. London Stock Exchange is extremely international, and we are very present in the Belt and Road countries, yes? We always look at this map and think, well, we have equities from 39 of these countries, yes? Listings from 39 of these countries, equity listings. Companies then come to the London Stock Exchange to raise finance. I have some of the stats here, yes? In the last 10 years, we have had 311 companies listed, yes? And they have raised 80 billion of capital. So you can really see, much more than in fact in debt, this is an extremely important factor. Obviously, we are also working with many of these countries, particularly in Africa, to develop the local capital markets too. Because, as you mentioned, employment, well, with money it also works, yes? If equity markets in Africa could be a bit more advanced, it will also help considerably to ensure that there is more country ownership, if you want, of some of these projects and of the development. And so that's also part of our long-term strategy, is working in partnership with local exchanges to do that.
I think that is extremely important. I mean, my big concern about our engagement from the UK in Belt and Road is that we are not moving fast enough. The fact that we don't have a strategic MOU with the Chinese, which perhaps to our mentality is not a very important thing, but in China it is hugely important because that gives direction to all of the state-owned enterprises, whether they be banks or construction companies, to go to a certain place for help. We've not been able to get that sorted out for very many reasons. I think it's actually acting as a brake on our engagement. And similarly, I think we are doing a lot from the City Stock Exchange, but we actually do need to do a lot more. And in terms of engaging, particularly in Africa, in the banks which are going to provide these vehicles for joint investment with China, we have a unique position to play there. But China has a reputation. If they find something isn't moving at the speed that they like it, they just go round it. And you can see that all the way down the Belt and Road. And I am really concerned that the UK is not moving as fast as we should be to engage in what I think is the most exciting major infrastructure development, not this century, it's this millennium actually.
So we're almost out of time, but just one last question, and this is just sort of a poll for the panelists very quickly. If you had to hazard some sort of an estimate of how long it'll take, we're sitting here in 2019 talking about the Belt and Road. How long will it take for this project to kind of, get to the level that we have all discussed here in terms of having all the financial nuts and bolts in place, the debt financing in place, and also all of the various parties being sort of on the same page? So, David, I'll start with you since you're sitting closest to me.
If I was optimistic, I'd say 2 years. If I was realistic, I'd say 3 to 5 years.
Martina?
I have to admit, I have never considered the question like that. I see it as a rolling thing, yes? Yeah. I mean, Belt and Road started officially in 2013. Investment in this country is obviously is much anterior, yeah? Much before. And these projects have a very long life cycle. Huh? So I think that we are always going to be starting and always going to be finishing. Some of the projects from Belt and Road are already operational. I mean, some of the railways in Africa are already working. Yeah. And some of the ports are already blooming. And I'm not just speaking about Sri Lanka. Never think that this is a finished product or that it's only starting now.
Yeah. This project will never be finished. No. It's going to morph. And our grandchildren are going to be talking about it. China kicked the ball off, and I think it's up to all of us to step in there and help to take it to the right place.